Today, a deeper dive into home prices. Hello again, it's Martin North from Digital Finance Analytics. Welcome to our latest post covering finance and property news with a distinctively Australian flavour. Now, I want to follow on today from my post yesterday, where I looked specifically at the way different price movements were being reported on various property portals and other sources. And we concluded that it was very, very unclear as to where the truth lay. But today I want to take this a little further and explore specifically how we should think about home prices. Because even here, things are not as clear or straightforward as you might first think. Now, to do that, what I want to do is to think about how a home price is constructed. Now, most people will start saying, well, isn't there a thing called price discovery? In other words, you've got buyers and you've got sellers and you've got people effectively making offers. It's a marketplace, and in that marketplace, ultimately, a price is settled. And of course, real estate agents are meant to be those, quote, honest brokers, unquote, that actually couple a seller and a buyer together and explore and reach a price. But of course, it's not always that straightforward, because they are going to be somewhat guided by the information that's available. And as we showed previously from our early analysis, depending on your point of view and the source, you can basically say prices have hardly moved at all or have dropped by more than 20% in Liverpool, which was the postcode that we looked at yesterday. And that's part of the point, because the real estate industry will, of course, be informed by the information that is there, but they'll also spin it and position it. Because remember, a real estate agent is ultimately there to try and get a deal. And frankly, a deal at any price, because a deal translates to commission to that real estate agent. And it's true, I think, that in a falling market, price discovery becomes really quite complicated. And the more prices fall, the more difficult it becomes to discover what true value is. And of course, those various indicators that we discussed yesterday is part of the problem, because we don't actually know how up-to-date that information is, nor indeed where it might be headed. And as one wag said in the comment section today on the earlier post, well, what you do is you take the midpoint and then you take off 20% and voila, you've got your asking price. Well, it may be that simple, it may not be that simple. So the question then is there an alternative way to think about how prices may be developed? And the answer is, well, there is, because instead of price discovery, you could build it up from the bottom. You could take the cost of the land and utilities and fees and charges. And remember, of course, that many local authorities and other agencies will actually take some fees on the way through. Now, it's also worth saying that land prices, certainly in New South Wales, are beginning to turn south. And in some parts of Western Sydney, prices have pretty much halved in recent times. Then, of course, you've got the construction costs and the other input costs of building the property. And we've seen quite recently in the high-rise sector how the construction costs have been managed down by using cheaper materials, imported materials, perhaps lower spec materials. I'm thinking of places like Opal Tower here, to try and bring the property lower down in price. And then you've got an element which I call an amenity value, because that essentially relates to where the property is. Has it got a view? Particularly sea views, of course, are often highly sought after. Is it close to schools? Is it on a main traffic route, or indeed on a local rail line? All of those things can add some additional value. But if you actually do the math on a typical property in Sydney or Melbourne, and you build it up bottom up from the land, from the construction costs and other inputs, and from the amenity value, we hit a problem. Because essentially, the sum that I come to is on average 40% lower than the price that would be expected based on some of the indices that are available or sought after by prospective sellers. And this is one of the reasons why I've consistently said it was quite conceivable that property prices could fall by as much as 40% if we just get back to what I call fair value. In other words, even after the recent falls, up to 20% or more, fair value is still significantly below the current level of prices in the marketplace. Now, of course, we can discuss a whole bunch of reasons why it is that property prices are significantly above the unitized build-up of prices, as I've described. And the most significant factor, of course, is availability of credit and the fact that that leads people to be able to pay more. And as they pay more, property prices rise. That creates more opportunity for banks to lend, and so on. And that spiral upwards has been one of the fundamental drivers for at least a decade. But now, of course, we're seeing quite significant downward forces on home prices. And it's worth just going through some of the factors which are forcing prices lower. And the first, of course, is the tighter lending standards and the focus on income and expenses detail, and, of course, not applying the household expenditure measure. As we saw in the Royal Commission, many banks were simply not worrying about the cost side of the equation. They were simply applying an HEM benchmark, and they believed that that would be sufficient protection within the meaning of the lending standards. Now, responsible lending standards is a bit of a flexible feast, and of course the HEM discussion with Westpac is still before the courts. But nevertheless, it's clear to me that the regulators have indicated that the use of an HEM is necessary but not sufficient to be able to meet the lending standards. So I still think that we're going to see much tighter lending ahead. Now, as a result of that, mortgage power, in other words, the ability of people to borrow for a given set of income and expenditure, has dropped, in some places up to 40%. It does vary by the type of household, the type of property, how big the mortgage is, and all those sorts of things. But nevertheless, people are not able to borrow as much as they once could. And that, of course, creates an interesting challenge when people are coming to be confronted with a refinancing proposition and they suddenly find they can't borrow as much as they thought. Or, for example, when they signed an off-the-plan contract and 2 years later they come to finalise the transaction and then discover that the value of the property has dropped and the amount of mortgage that they can get has also dropped. In fact, I'll be discussing this on the mainstream media tomorrow morning, and I'll post that here subsequently. Then, of course, foreign buyers have dropped away. There's been a significant fall in the number of foreign buyers, partly because of the fact that as property prices have started to slide, the prospect of making a quick buck on the way up has dissipated, plus tighter regulations, both in China, for example, and locally here in Australia, where there are now extra fees and taxes imposed on foreign buyers. So that party is pretty much over. And there's also been a restriction on self-managed super fund borrowings. Pretty much all of the majors have now basically said unrecourse borrowing will not be allowed. So that basically means that buying a property through a self-managed super fund is much harder than it was previously. And of course, then we have the interest-only borrowing restrictions. Now, whilst the formal restrictions have come off, there are around 120 billion of interest-only loans to be reset this year and next year and pretty much the year after. And a proportion of those will not now meet the new tighter lending standards. As a result, they will either have to take a principal and interest loan and pay 40% more on their mortgage, or restructure in some other way, perhaps extending the term of the loan, or selling the property. One reason why we're seeing more investment properties coming on the market at the moment, people are being forced to get out because of the interest-only problem. And then the final point is that investors are now less likely to transact because the capital growth that was expected, and it was a really critical part of the proposition, is just no longer there. Which means that for many investors, holding property and buying property at this stage doesn't make any sense at all. And just to add to that, returns on rentals, particularly in Sydney, are now considerably tighter. Vacancy rates are higher. And certainly my calculations are that about half of property investors are underwater in cash flow terms, which means that they're losing money week in, week out, month in, month out. So expect more property investors to exit the market over the next little while. And whilst it is true that if Labor gets in and they bring in negative gearing, it will make borrowing for existing investment properties rather than newly constructed ones harder because negative gearing will be abolished. My own modelling suggests this will have only a minor effect. And there won't be a massive surge of property investors trying to get into the market before 1st of January next year if Labor were to get in. I think that's a bit of a furphy. Now, at this point, it's worth just recapping on the new loan flows. So this is data from the ABS, and it shows that over the last year, new loan owner-occupation flows are down 14.2%, and investment loan flows are down 28.9%. And this slide really shows the criticality of the so-called credit impulse. In other words, the rate of change of credit availability. And the fact is that this shows a likelihood that property prices will continue to fall further ahead. Now, if this was to start to tick up, that would be an early indicator of property prices beginning to recover, but I can't see anything so far in the data to suggest that this is very likely. Now, there are some other factors to bear in mind too. There are high interbank funding costs. Well, at least they were a lot higher, but now things are beginning to change here too. Now, this is the bank bill swap rate from April last year through to date. And until recently, we were seeing very considerable rises in bank funding costs, which meant that the banks were under significant pressure with regard to their margins. But now, the basis point difference between then and currently is minus 8.3 basis points. In other words, the banks are beginning to have some margin to play with. Now, what they're doing at the moment is offering new loans to borrowers with a low credit risk to try and attract new business. And some of them are now beginning to make changes to new loans on a variable basis too. But there's no intention that I can see to pass on any of this reduced BBSW rate to the portfolio, because essentially banks are relying on the higher rates in the portfolio to support their overall profitability. And bear in mind that if the Reserve Bank were to cut rates later in the year, the cash rate, it's not really guaranteed that banks will pass those on to borrowers simply because we're reaching what's called the zero bounds problem. In other words, as rates come towards zero, it's harder for banks to pass on any of the margin. And I expect in the next reporting round, which will be happening quite soon, the banks will continue to display margin compression. In other words, tight competition for new loans from existing borrowers of refinancing or new loans for new borrowers, particularly first-time buyers. But anyone with a high loan-to-value ratio or anyone that happens to be in a particular postcode where there is a high concentration of risk perceived by the banks will be unable to access some of these cheaper and more attractive deals. And it's just worth remembering that earlier on, we did have rising mortgage costs and interest rates. And in fact, the Reserve Bank reports that mortgage rates are on average a little higher than they were a year ago. And of course, NAB held out for quite some time, but then ultimately capitulated and then lifted rates out of cycle. So pretty much all the majors are on the same playing field at the moment. And we've still got risks from class actions and the outfall from the Royal Commission. There are a number of actions in train at the moment designed to focus in on this concept of responsible lending. And whilst the Royal Commission is over, there are still potential further legal issues to be explored by the regulators. So it's not completely past yet. And this is still having quite a big shadow on bank behaviour, in my view. And there are a bunch of other factors too. Now, it's important to remember that the profitability of the banks are fundamentally linked to their mortgage book. And with lower mortgage growth and with the credit impulse easing, my calculations suggest that bank profitability will be under considerable pressure ahead. And that's before we take account of higher risks in the portfolio due to negative equity and higher levels of default, or indeed the need to market the portfolio, which at some point may come into play. So if I go back then to my fundamental question, if property prices are going to move towards a more fundamental basis of valuation, we could see property prices still fall by up to 40%. Now that might be offset by more lending behaviour, cheaper loans, and indeed even lending standards being loosened somewhat. But that'll be only at the margin, because the new tighter understanding of lending, and responsible lending in particular, means, to my mind, the banks have very little wriggle room at the moment. And so this takes me to my final point. If you really want to know what the true value of property is at the moment, you probably need to take something like 40% off the current perceived value to get to a more long-term fundamental sustainable value. And the question to ask about that is, how many people will be comfortable with seeing a 40% haircut on their property? And what will that potentially do to the equity that people thought they had, their plans for retirement, and indeed the whole housing and banking sector? And this is why I'm of the view that we may be at the end of the beginning of house price corrections, but we ain't seen nothing yet. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.